Welcome to the Wise Wealth Podcast, Week 7.
Yes, sir.
Let's go.
This is a fun one. We've got a awesome topic. I'm very passionate about it. I know our guest, Jacob, is passionate about it also. He'll tell you more about himself. But, this is we have a guest appearance on the show today. So there's 3 of us, and we're going to be talking real estate.
Powerful.
Real estate and IBC. Wow. When you combine those two, it's like a
PBJ.
It's like perfect. PB and J. What else? Give me another one. What else is it? What is it like?
It's like chicken and waffles.
Chicken and waffles.
I just went to Cracker Barrel, and it's like fried chicken in French toast, like my daughter just got.
Fried chicken. I haven't had that one together either.
It was really good. I had a bite.
And I'm hungry now. I'm thinking about breakfast, steak and eggs, maybe. Like, what do we got? What else we got?
Good thing.
Well,
good
if you're from
protein
Colorado, it's like the pork green chili and huevos rancheros with some hash brown. That's a real Mexican breakfast, y'all. Come on now. Where's those California burritos at? Where's those carne asada fries at? Come on now. You know what I'm talking about.
There he goes.
All right, let's get back on topic.
Cool. Jacob, why don't you tell our listeners and viewers a little bit about yourself? Where are you from, and what do you do?
Yeah, thank you, guys. Thanks for having me this morning. So I'm from Nashville, Tennessee. I work in luxury real estate here in the Nashville market. I've got 3 kiddos and a beautiful wife, and the kids' ages are almost 4, 2, and almost 1. So we love our little kiddos. We chase them around all the time, and we just try to have fun.
Very nice. How long have you been in real estate in Nashville?
Yeah, so I've been in real estate about 5 years now.
Awesome. So luxury real estate, how'd you get in? That's like a little niche market, I guess. Why did you go that route rather than just, just a general real estate agent?
Yeah. So for me, real estate it can be very demanding on your schedule. And so family is really important for me. And so I just figure if I can, maximize my client interactions, when I'm helping people, because there's teams that do, 100 transactions a year and things like that. And you can do that if you have a team, but I don't have a team. And so for me, it made more sense to kind of work with folks, in those higher price points. And I don't exclusively work, luxury real estate. I still, work with, any price point, and, investments are usually the lower price point. And so, I do a little bit of everything as well. So.
Very cool. That's awesome. So tell me a little bit about your IBC journey. Let's just start out with how did you hear about infinite banking or the private family banking concept? How did you first hear about it?
Yeah. So there's a couple parts to that story. The first part is maybe it was about a year ago. A buddy of mine kind of introduced me to infinite banking, and he said, "Hey, have you read, this book?" And so I think it was Millionaire Mystery or something like that.
Yeah, that's a good one.
Yeah. And actually read that a few times. It was probably 2 or 3 times. And then I got my hands on another book, Becoming Your Own Banker, which I'm sure you guys are, recommend. Yeah. And then I think I read another one. I think it was Real Estate Investing Lies. And so I read those and reread those. There it is right there.
Yeah.
Yep.
I started to kind of wrap my head around it. And then that's part 1. And then part 2 is, it was probably 2016 or 2017, a year or 2 after my wife and I got married. We sat down with a large firm that does, life insurance and does some other things. And we got something that wasn't structured correctly. So we had a policy that we couldn't even get anything for the first 8 years. So we basically had $0 the first 5 to 8 years. It was something like that. It might've been 5 years because
my heart, it's hurting.
But there's a happy ending. There is a happy ending because my heart hurt too. Especially when you look at the statement, you're like 0, 0, 0, 0, 0 for the first several years. So it doesn't even start until year 6 or 7, but yeah. So there's a happy ending. I can tell you a little bit more about that later. But we had a policy. But the good news is that that's being 1035 exchanged over to properly structured policy. So
it's great.
That's good. Yeah, you'll have to go back, and I believe it was for our listeners, it was either we're on episode 7, so it was either 5 or 6, and we discussed policy design. I believe it was last week, Joe.
Mm-hmm.
We did policy design. That's a good one to go back if you're a little bit confused. We're not going to dive into what happened to Jacob on this one, but it was a poorly designed policy. It wasn't exactly what he asked for, most likely, and it didn't have cash value. And we love cash value, so we can access that cash and do things of life as they always
value. You see the value of education right there, though, Jacob, right? Because
yes,
you didn't read a book or 2 books or 3 books, and you didn't have a friend plant a seed that was watered by knowledge, and then you took action. So this is the power of getting educated, not watching a TikTok or watching a commercial. Man, it's so powerful. And this is so simple. Like my guys, to read, all you got to do is read. I love Andy Andrews when he talks about people don't read just because they just haven't found anything that's exciting to read that, gives them a passion to want to learn. My daughter's read 7 books this month. If a 12-year-old girl can read 7 books, and we just left the Jesse Owens Museum. We went to the Jesse Owens Museum on Sunday. He grew up an hour away from my home. We watched the movie Race, which you haven't seen Race, guys, watch the movie. If you just want to be inspired to do something great, here's a family sharecropping, picking cotton, this boy, with nothing and having dreams of going to college back in the 1920s. I'm getting off on a tangent, but I'm just telling you, when we went there, my daughter saw his biography, and I bought that book for her, and she's reading. It's expanding her vision, expanding the possibilities, and all those things. So you read the book, though, is the point. So what I'm saying is it's your fault that you had I'm just kidding.
but Joe, you're right.
Yeah.
You're right. And it is his fault. It's also my fault that I didn't start one of these when I opened my first business 15 years ago. It's my fault that I don't have that cash value because I didn't utilize one of these in my business structure.
Yeah,
it's my fault. Yep. It was my fault because I was probably less open to hearing about things. I had tunnel vision. I didn't explore other opportunities to bring in and make a really, really solid foundation. It's my fault. So you're right. It is Jacob's fault that happened to him because he could have walked into there if he had known about it. He could have walked into there and they would have showed him some illustration. He would have said, 8 years? What? Or I think we want some numbers in this column that are actually useful.
And not zeroed.
Not zeroed out. Exactly.
That's why what we do is so powerful is to educate, listen, then facilitate instead of just, here, this is what you need. It's education is what's so important.
Yeah, absolutely. So go, Jacob, did you have more to your, the beginning of your IBC story? So that thing's getting 1035 exchanged. Tell me, I don't know if it's active right now or you got a different policy or I guess tell me a little bit about some of the strategies that you're either going to use IBC for or have used IBC for, or maybe any of your clients. I'll just let you have the floor. Go ahead.
Yeah, no, that's great. I don't think I mentioned either, but I'm also licensed in wealth strategy too. So I read those books and read them over and over and was like, we've got to implement this in our family, like more. Because I'm saying more because I'm considering that poorly structured policy. We did still get to use it. So I guess I'll answer 2 questions. The first one is, once I had read it and read those 3 books 3 or 4 times each, I was just thinking, you know what, I'm totally on board with this. And And my buddy who introduced me to this stuff, I think he was on vacation or something. And so I was like, hey man, when can we meet? He's like, I'll be back from vacation, on, X day or whatever. And so then I just like put my head down and just got my license and
Nice.
did that. And just to write our own policies for our family. And
yeah.
So for that policy that is being 1035 as we speak, I'm going to be faxing those final documents over today. We have a rental property. We have a single family rental property, a long-term rental. And on, I think it was Martin Luther King Jr. Day, 2022, it was freezing here in Nashville. And of course our HVAC went out. And so our poor renters had to deal with that. And so we went and bought like space heaters for them so they could do that. But we were looking at financing options for the HVAC unit. And I remembered, I was like, oh, we can just use the policy loan function. And so take a loan against our policy, take a loan from the insurance company, and then we can let that continue to grow, as we pay for this HVAC unit.
All right, so let's just unpackage that just a little bit so everybody really understands what you did. So you were looking at, hey, we had an emergency at our rental property, and you had to buy some, the heaters, fix the HVAC, lots of stuff going on at one time, and it dawned on you, okay, we've got cash value inside of our infinite banking policy. So what did you do? Did you have to go through a credit check, underwriting to get because you said a loan. So how does that work?
Yeah, thanks for asking. Yeah, so it's really simple. The great thing about taking a loan against your policy is that nobody asks you any questions. You don't have to do a credit check. There's no underwriting. Okay. It's fast.
So
stress-free.
Stress-free. So you're in real estate, you know how the mortgage process is. It was nothing. It wasn't even on the same Richter scale. So you probably sit in one piece of paper with your, upload a piece of paper to your account online after you logged in. They said, okay, you'll have the funds in your account, or I guess if you wanted a paper check, they could send you a paper check. And that was it. No credit check. You didn't get a ding on your credit with an inquiry. You didn't have to go through underwriting, answer a bunch of questions. You didn't have to put up collateral other than your life. It's a life insurance policy. So none of that had to happen. It was stress-free. So you're coupling that with a real estate investment property. Man, the stress level must have, it was more at that point, it was more of an inconvenience rather than a financial emergency. Am I correct?
Yeah, it was, but I mean, if you do have a financial emergency, I mean, that's also great use for it as well,
Yeah. Because I mean, that could go a whole different way where, okay, you've got renters in the property, it's freezing there, and say you didn't have the capital set aside for that CapEx at the time. Like you didn't know, you weren't expecting, everything to go haywire at one time. So you had those funds set aside. It could have gone differently. I mean, you could have had to, get a very high interest loan or something like that, and that really eats into your cash flow as a real estate investor.
Yeah, absolutely.
So you took a policy loan. Without getting too deep into it, I'm gonna assume you did like the variable loan or a non-direct recognition loan where the funds were still growing inside your policy. You paid for the HVAC heater stuff that you needed, and you'll pay yourself back over time as you see fit to get those cash values replenished back into your policy. But at the same time, your cash value is still compounding over inside of your life insurance policy, your infinite banking policy. It's still there, even though you've deployed the funds into the emergency. Mm-hmm. That's powerful.
Yeah. And something I love too is that it doesn't, I mean, if you miss like a payment on something, like any other person you take a loan out with, like if you miss a monthly payment, then you're going to be in some trouble, like a HELOC, like a home equity line.
Mm-hmm. Yeah.
And so for people like realtors, I think it's super important because sometimes business can go like this.
Oh yeah.
And so when you get a check, or you sell a house or, help some clients, then you can pay a portion back. Or if you have a large check, you can pay your entire loan back at once if you want. You have so much flexibility with policy loans with permanent life insurance. So
that's so
especially
important.
right now. Right. I heard, I was just talking to a business partner in Dallas. I believe he said over 35% of realtors in Dallas right now aren't even paying their desk rent, their rent. It's
Wow.
it's a tough time right now. So when you have the flexibility to pause and pay yourself when things start coming in, I mean, hey, this is a tough time right now. I mean, people are. I mean, when was the last time you guys went to the grocery store and $100 went as far as it's going? And
It's astonishing. Every time I do it, I'm like,
yeah,
wow.
yeah.
That was $100, 3 bags.
So if you want to start accumulating cash in a bank that can grow tax-free, that you have access to, that's liquid, this is, we're helping someone in the real estate space right now who's probably listening to this, who wants to do a huge dump in to immediately pull the cash out and buy a property. It's probably over $200,000, 200. And her one regret that she was thinking is, man, I should have done this sooner, instead of dumping it all in at once, which someone can do, but to build and build and build, to have that cash over, and so that's people always say the same thing, right, Ty? I wish I would have started this 20 years ago.
Yep, exactly. I hear it all the time. So it's good. Thanks for that example, Jacob. What other ways have you seen your clients that you have, maybe real estate investors, or things that you're doing that you're using IBC or the infinite banking policy?
Yeah. So maybe some people that are listening maybe not be as familiar with things called hard money loans. And so it's actually how we bought our house. So we have our rental, and then we moved to our new house through like a hard money loan. And so basically what that is you just work with a private lender, and you come up with the terms, you write up a promissory note, and you just come up with the terms. And so you choose the payment, the interest rate, all those things. And so one thing that's that's really great for people who either are doing hard money loans or want to get into hard money loans is that you can have your money growing in a policy and then take a policy loan and then loan it to someone, and then they can pay your loan back for you. And so you've got two things kind of growing. You're gaining the interest from the hard money loan, and then you're also gaining from the growth inside of your policy.
Very nice. So typically hard money loans are going to be your less favorable, in comparison to like a conventional mortgage per se. Somebody's going out for a conventional, or, a real estate investor's looking at doing a conventional mortgage on a rental property as opposed to hard money. The hard money is going to be probably easier to obtain. Correct me if I'm wrong, Jacob. Hard money is going to be easier to obtain. Conventional, you have to jump through many more hoops and show more documentation, more employment stability to get that conventional for the more favorable. But if you can't, and you had to go hard money, having access to an IBC policy that could be your, either personally or to make an investment, could be your hard money, or you could become a lender, just like you said. And the rates inside of the infinite banking policy are going to be much less than hard money. Typically, at the time of this recording, they're between 4 and 6% for a policy loan. If you want a variable, probably a little bit lower for a fixed loan, but between 4 and 6%, and probably hard money is going to be at least double that.
Yeah, I wouldn't imagine you'd see anything even around 8, might be like 10, 12%, something like that.
Yeah.
So it's more expensive for sure. So it's nice to have your own policy that you can just loan to yourself or your family members even,
Yeah. Private family bank, you could have family members that are, you have the capital, you're going to loan it to them, and they're going to pay it back with interest over time. And you can make up your own interest rate, right? You could, if the insurance company is, your bottom interest that you're owing the insurance company for the policy loan is 5%. There's nothing that says that you can't say, it's a 7%, because you're putting it back into your policy, charge 7% for your services.
Absolutely.
It's just making the family as a whole more wealthy.
And even if you just did a wash, you loaned it at 5%, but it still grew 5%. You're still going to, your money's still compounding and growing. Even if it's apples to apples, the money that you took to borrow, the money that stays in there is compounding at a greater rate. So I think we gave that example in episode 3, right, Ty? Or with Jesse Reynolds, I believe we gave. Yeah, we have the numbers on that.
Absolutely. One example I want to chime in on, what I heard recently was using the policy for like a real estate investor. Say you have multifamily and you're not escrowing your taxes, you're not escrowing your insurance payment. So over the course of 12 months, you should be escrowing it to yourself. So instead of that money sitting and kind of rotting away in a bank account, what an investor can do is have a policy, for this, you got a 12-unit complex or something, and you're going to put, several $1,000s, maybe tens of thousands of dollars, depending on how high your taxes are, inside of your policy. And then you'll use the loan feature. And then the next year, you're going to pay yourself back into the policy. Use the loan feature again. So each year you're paying off your loan, but yet your cash value is going to start to exceed the monies that you're putting in there over time. This is not a get rich quick strategy, but over the course of 10, 15 years, just using the escrow, the amounts that you need to escrow to send off to your local taxing authority or to the insurance company, you can make those, you have access to those funds, and you can make those grow inside the policy. So that's one strategy that I saw that I thought was really, really, really cool for real estate investors to use.
Yeah, no, that's really good. And kind of, if you go down that route, I mean, you can talk about, paying for taxes because you kind of like escrow. If you're a business owner, you kind of hold that in a business account. That could be a policy, or even if you're going to do a like a self-insure. And so you want to, instead of doing because I run into people every time we write a contract on a house for a buyer, I always ask them, in Tennessee, there's a space in the contract where you can check a box and write in some stuff that says, basically, do you want to pay for a home warranty, or do you want the seller to pay for a home warranty? And that basically just insures usually appliances and that sort of thing, even though there are some things where sometimes those insurance companies get out of it because there's a technicality or something. And so people always say, like, it's a 50-50 shot whether they either had a good experience with home warranties or a terrible one. And so you could just remove the middleman and then self-insure yourself. And then all that money is going to just build, instead of having to pay the same thing over and over every year and then just lose it and have to start over in the new year.
Wow. That's something new I learned. That's powerful.
Yeah. That's a great strategy. I like the self-insuring for, those appliances and stuff inside the house, whether it's just, maybe you're not a real estate investor, but maybe if you own a home, at some point your refrigerator is going to need to be replaced. Your AC unit could go out, and it's going to go out at the worst time. If you're in Florida, it's going to go out in the middle of the summer. It's going to freeze over. They're going to say, hey, your capacitors are blown. The thing's frozen over. Like, it's not going to be at the ideal time. Murphy's Law says it'll be at the worst time. So if we plan for that, you'll be able to self-insure yourself. So you won't need those, home warranties per se. You can, if you want to take the risk on yourself and build that capital inside of your policy, you can do it. I just thought of this also. A lot of times with your car insurance, you certainly want to talk to your auto insurance advisor with this, but you can make your deductible higher. You can have the same limits of coverage, make your deductible higher that you need to pay out of pocket. If something happens, like say if you have like a $50 deductible, that monthly premium is going to be much higher than if you say, hey, I'm going to stick $1,000 in my checking account, and if I get in an accident, that's $1,000 that's going to pay for my car. But instead of sticking it in your checking account, stick it in your infinite banking policy. So that $1,000 will actually get larger over time. So that's something that just dawned on me. So instead of having a recurring, you got a $300 car insurance payment, you could say, hey, give me the little bit higher deductible. I'm going to stash cash over here, and you have to be disciplined enough to know, hey, don't spend that on a TV. That's for emergencies. So as long as you're disciplined enough to do that, that could potentially be a good strategy. Again, you'll want to check with your auto insurance advisor about what that pricing, what those coverages would look like for you.
Yeah, I love that you guys place a heavy emphasis on education and discipline, because like you said earlier, this is not like a get rich quick. And if you can't control your impulses to not spend money, like, you're not going to be able to build wealth anyway. So this strategy won't be for you. And so it's just one of those things where discipline, education, and I have to get better, right? Like I have to get good and get good habits in order to even implement this stuff. So.
Yeah, absolutely. That's what we're all about, man. We're all about the education. We're all about making sure that clients know what they're signing up for. I couldn't tell you, and especially over this last season, and I've spoken to so many people who either have a policy or they were talking to somebody about a policy and they had no education. It was just kind of like, hey, sign up for this. And some of them got signed up for this and they don't know what this is. Yeah. So, IBC can be for everybody. I really wholeheartedly believe that infinite banking can be used in any household across. I mean, if you're putting $50 into a policy, or if you're putting $50 million into a strategically structured, probably number of policies, it can be used for every single person. But either of those price points would fail if there's lack of education. Both of them. You have to be educated, and then we've been talking about discipline. You got to have the discipline and the mindset. We did a whole podcast on mindset. I'll have to start writing these down, Joe. I don't remember. It was this will get worse as we do these each week. I think it was week 4, episode 4. We did a mindset one, and that's so important. We're going to do a part 2 on that because there's so much to unpackage on mindset. So, you have anything to add, Joe?
No, I love how, Jacob, you, man, I got to meet you in person and spend time with you. And even since I've met you, you've grown. And I love how you're all about adding value, massive value to your clients. And, that's what I would want in a realtor. That's what I would want in a professional, someone who is going to add value to me, because you're sharpening yourself and you have tools in your tool belt, and so this is great value. Tell the people how they can look you up, find you, get a hold of you, ask questions. How can people get a hold of you?
Yeah, so I'm on Instagram. I'm just Jake_Seeley, and so you can find me there. You can text me if you have questions. My number is 615-571-2588. Yeah, those are probably the 2 best places to find me. I'm on Facebook as well, Jacob Seeley. So any of those places will answer quickly. Email, sometimes I don't get, like if I'm out and doing showings and things, sometimes I won't get to you as quickly with email, but those other 3 ways, Facebook, Instagram, or just text, is probably
awesome. Let me give you one more final question before we leave. As someone who may be looking to buy a home in the future, give them one nugget of something on the outside, looking in, that they don't know about, but people in the real estate space that they need to be aware of, maybe some things to look out for, or things to, how do they know they have a good realtor? How do they know they're going to have someone that's going to take care of them and really, or what are some great indicators they should be looking for?
Yeah. So in a realtor.
Yeah.
Yeah. I think, such a loaded question, but I think if, you're looking for someone, I think that you should find someone who, this is going to sound oversimplified. I'll see if I can make it make sense though. That's interested in you and doesn't try to be interesting. So basically what that looks like is they don't talk that much, or when they ask you a question, they don't try to answer their question or guess. They're just going to ask you a question, and then they're going to follow up that question with why, or what's important to you about that. And sometimes it sounds, almost like a goofy script or whatever, but really like, if I try to guess why you want a certain thing about your house, like I'm never going to get it. Like I'm just going to on what I think it should be. And so they're just going to look like a person who asks a lot of really good questions and asks it several levels deep. And then they understand what you really need and what your family needs. Because what I find is, especially in like the home, like purchasing process, people will say, well, we want this many beds and this many baths and this bonus room or this kitchen or this whatever. And usually people will flex on that stuff. They don't realize that they will, but because they're just trying to attach those things to what's really important to them and their family. And so sometimes those things can change. And so I think it's important to really know. Sometimes I feel like I understand a little bit better what they need than they really realize. And so I just kind of like will show them things sometimes that might not necessarily be what they asked for, but I'm like, I feel like this might help. This might be what your family's about. Like you said, you want this for this reason for your family. Why don't we just take a look at this? And sometimes they switch, or out of necessity, or other reasons. So
that's great, man.
It's good. Awesome. It's almost like you're educating them, because you're a specialist in the real estate area, so you're educating them on something that might fit their mold based on you listening to what their needs are and then presenting them with solutions.
Powerful. Awesome. Well, thank you guys for joining us on the Wise Wealth Podcast. Be sure to download, like, subscribe, give us some 5 stars. This is our gift to you, giving you this great content. You guys go ahead back and you guys can, your gift to us would be sharing this, giving us 5 stars so we can get the word out. Ty, any last words, brother?
That's it. Subscribe,
Peace.
5-star reviews, and we'll see you all next week.
Next week.